Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I think I've got a really interesting episode, hopefully interesting episode for you today, really about something I get asked a lot about, particularly on, social media like YouTube and so forth. And it sort of links into a episode I recorded in August last year. Episode 319, just in case you want to go back and have a look at that. And in that episode, I talked about how to determine whether it's worthwhile for you to get financial advice, because that's kind of the question I get asked a lot. Is it worth me paying for financial advice? And just as a bit of a sort of summary, I sort of talked about, how the cost of financial advice, the cost to deliver financial advice on an ongoing basis, mainly because the government's completely messed up the compliance regimes, is around about $5,000 a year. So if you have a look at what the average planner is charging, that's a lot of money, of course. And it's not worth you paying $5,000 a year if you're not going to get $10,000, $15,000, $20,000 a year in value, of course. You want to be much better off in the long run for the advice. You're not going to be better off every year, of course, because some financial advice, in fact, good financial advice is long dated. But I guess a better way to put it is if you're going to pay a planner $5,000 a year for the next 10 years, that's 50 grand. I think in 10 years' time, you want to be multiples of that better off to make it worthwhile. And that's what I sort of talked about in that episode. And I talked about, what are the things that advisors can help with. And, in the current environment with, a lot more share market volatility, behavioral finance and trying to stop clients from doing silly things like, exiting the share market, for instance, might seem like a good idea over the next few months or even over the next year. But looking back in 10 years' time, that would be a mistake for most people. So even helping them with something like that is pretty significant. And as you can imagine, we're having a few of that, not many, but a few of those conversations over the last couple of months. So today, what I wanted to talk about is, well, if it's not worth you getting financial advice yet, maybe in the future it might be, but you look at it, look at the moment, it's not really worth you paying $5,000 a year. What do you do? And that's what I'm saying. That's the common bit of a preamble, long preamble, but that's really the common question that I get that I'd kind of like to focus on today. Okay, so let's get into it. What I'd like to do is start by talking about the two sort of financial decisions that you could be confronted with. And I would categorize them into straightforward financial decisions or complex ones. So straightforward financial decisions is where if you have an understanding of basic fundamentals, that the right answer should be relatively obvious to you. And, it's exactly why I wrote the book Investopoly, which is obviously the podcast is named after the book. I wrote it back in 2018 because what I found is that I met with, lots of clients, and on many occasions, the answer to me in terms of what they should do next or how they should approach a particular financial decision was really obvious. And so I sort of sat back and thought about, what are the fundamental kind of rules or concepts that people need to understand in order to answer those questions themselves? Because for me, been doing it for more than a couple of decades and having literally thousands of different meetings, you would expect that I'm going to be pretty good at, understanding someone's position and going, yep, bang, this is the right approach. Go and buy an investment property. Don't buy an investment property. Make additional super contributions. Invest in the share market. Reduce debt, whatever it might be. It could be a combination of those different things. When I'm faced with a straightforward financial decision, it is relatively straightforward to find that answer. And that's where I came, I talk about in the book, the 8 fundamental rules or principles that, you need to understand to be able to answer those questions yourself. So for example, if I'm faced with someone that's, in their early 30s, that owns, one property, for instance, that was an investment property, and their plan is to go and buy a sort of forever home. What should they do next? That's their sort of longer term plan. Well, of course, they should go and buy that forever home as soon as they possibly can, because getting into the market And it means that you're going to pay less on an after-tax basis for the same property. So even if you go and buy it now and use it as an investment, pretty good strategy. And, that's just not my opinion. That's really based on those rules, and which are really founded or backed up by basic mathematics, really. And so in those situations, it's relatively straightforward. Now, of course, the other category is complex financial decisions. And that's obviously when they're not straightforward. The definition's relatively obvious, right? So usually that's a situation where there's greater complexity in someone's financial position, or they have multiple viable alternatives. So there's a number of different things or ways you can go, and you're just not really sure, how it might pan out. For example, I had a meeting with a prospective client yesterday, and they have a really strong cash flow. So, they could probably go and buy another investment property. They already own one, potentially buy another 2 or even 3 investment properties. They could, maximize super. They could do some share investing. There's lots of options available to them. And it's not clear in my mind, without doing some work, on what are the proportions, because they've got some lifestyle goals as well in terms of rebuilding their family home. So what proportions should they focus on each of those different options, or are some of those options just off the table and not appropriate in their situation? That's when it's more complex and the right path isn't obvious until you do some work, and you don't want to take guesses, right? So I'm not saying throw darts at dartboards. When you've got a straightforward financial decision, the right approach should be obvious because of the fundamentals. But if it's not obvious, then you really got yourself a complex financial decision. So in my experience, investors don't really face complex financial decisions until they're deeper in their financial journey. So I guess, sort of in their 40s and 50s, the financial decisions start to become more complex. But in their 20s and 30s, most financial decisions are relatively straightforward. And so that's what I really want to talk about in this episode today. How do you go about navigating those straightforward financial decisions to make sure you're going to get it right, to make sure you don't make costly mistakes? And you can keep applying that approach until you come up against a complex financial decision. And because you've got more complexity, and because there's, some potential different avenues you can take, there's lots of different avenues you can take in a complex financial decision situation, then it is worthwhile paying for advice, but there's no point paying for advice until you sort of get to that time, if that makes sense. And in fact, it's entirely possible that a whole bunch of people out there will be able to navigate, these straightforward financial decisions for the rest of their life. Maybe they don't come up against any complexity. Okay, so how do you do it? What is the approach? Well, I think it's a 2-step approach. I mean, the first thing you need to do is educate yourself. Now, you don't have to become a financial expert, but you really do have to grasp the fundamentals well enough. And this is the sort of stuff that I talk about in this podcast. It's the reason I wrote the book Investopoly. But there's lots of different books out there that will talk about fundamental concepts. I'm not talking about strategies. Some people will write books, or there's blogs and information about strategy, something that's going to work in this market, something, they're selling an opportunity. What I'm really talking about is what is the approach to investing in shares, for example, that has worked over the last 10 years, over the last 50 years, and will work for the next 10 and 50 years in the future. These fundamental concepts of just understanding markets and options and these sorts of things. So you've got to be really careful about what sort of information or education, in inverted commas, that you're really listening to. Let's make sure that it's, really focused on these fundamental concepts. I try very hard to make sure I never talk as little as possible about what we do, my business, these sorts of things. I'm not here to sell you anything. In fact, in our business, we've got nothing to sell. Like, we're not buyer's agents. We don't make money from people investing in shares or where their super is invested. We're completely independent from that perspective. And that's good, because I can bring an independent from an asset class as well, whether it's property or shares. As you know, I talk about both in this podcast. I'm not saying mine is the only information you should consume, but you want to have that information that's kind of brought to you on the sort of same basis. And I think an evidence-based approach and evidence-based information makes sense as well, because they're backing up with evidence. which might be just sort of sound logic or basic maths. It doesn't need to be difficult, and any fundamental concept should be relatively easy to explain, which is why I don't think you need to become an expert. You just need to, have a relatively logical mind. And if you do, you should then be able to understand the concepts, the broad concepts, kind of like the 8 rules I talk about in the book. So that's the first step to navigating straightforward financial decisions. The next step is you need to find yourself a mentor. Now, of course, this could be a friend or a family member or someone like that, someone that has, trod the road that you're traveling in terms of building wealth and taken the similar approach that you want to take. So, make sure they've eaten their own cooking. So it could be a friend or family member, but I think the best kind of mentor, if you like, should be one of your professional advisors. So a great mortgage broker or a great accountant. I think these two professionals tend to be great mentors, particularly if the individual themselves is an investor or they work in a team that's heavily focused on investing. Again, both in property and shares, you want to make sure that they've got a really balanced approach. Now, I'm not saying you should take financial advice from an accountant or mortgage broker, not strictly in that sense, because most of those professionals aren't licensed to give financial advice. And you want to be really careful about who, the advice that you're kind of following, if you like. But there's some accountants and mortgage brokers out there that are particularly financially savvy, often because they've built wealth themselves. And their primary motivation is to really help their clients. They're not about sort of selling a product or these sorts of things. There are some great individuals out there. And a good mentor can kind of steer you in the right direction and stop you from making, really costly mistakes. And perhaps the most valuable thing they could provide is connect you with their trusted network. So, the first step is to understand the fundamentals. And if you understand the fundamentals, hopefully you can kind of work out the answer yourselves. And then you can then have a chat to that professional mentor and you can say, you know what, I'm thinking about buying another investment property. I know this is going to take my gearing to this level, but here's the longer term plan. And a savvy professional like that will go, yeah, that seems fine. Or, no, you're just about to make a huge mistake. Have you thought about this? So they're not really there to determine the answer to the straightforward financial question. They're really there to give you the guardrails. And as I said, the other thing is their network is really incredibly important. I mean, that a good mortgage broker and a good accountant will have a really great network. Again, typically someone that's really focused on helping their clients because, that helps them build that network. And also someone that's, trod that road before. So they're actively investing themselves. They will be able to point you in the right direction. Finding the right people to help you is really a big part of being a successful investor because often it's not a what question, it's a who question. So it's not a, what property should I buy? What ETF should I invest in? It's like, who can give me that answer? Who's in a much better position than I am to give me that answer? And I think about, surrounding yourself with a great team is going to help you do that. You can try and do it yourself through trial and error, but again, a great professional will have typically a great network of trusted individuals. Okay, so how do you find yourself a mentor like this? It's it's a good question, and I'm not sure why I am asking myself a difficult question. But I think like any professional that has a high level of trust associated with it, I think referrals tend to be the best way. So, I think I'd be asking around and speaking to people about their accountant, what conversations they have with their account or mortgage broker, how have they helped, what investments have they made that's worked out as a result of those sorts of conversations. And I think I'd keep asking around until, I came across someone that said, yeah, my accountant's really savvy. He's on the ball. He's referred me to different people. They've always been great. And that might be the best way to find a sort of professional mentor like that. The other way, if you can't get it through referral, I guess the only other way is to look for, professionals that kind of actively produce content such as blogs, podcasts, and articles, kind of like what, I do, because quite often people like me just like to share information. They get a kick out of sharing information and helping people. And it sounds altruistic, but really it's very selfish because I'm doing this because I really enjoy it. And the positive side effect is obviously, hopefully, it helps lots of people too. But those people tend to be ones that will produce content like this that without necessarily a big sales pitch, because they're just mainly motivated by helping people rather than ultimately, generating some commercial benefit. Of course, we all know that, if your focus is on helping people, the commercial benefit will follow, of course. But they're probably the two ways to kind of find these individuals. Now, when will this approach not work? Well, of course, if you're ultimately faced with a complex financial decision, even though you might think initially it's straightforward, maybe if you can't find the answer yourself and it's just too hard to find the answer, eventually you might be faced with a complex financial decision. And that's the time when it's worthwhile paying for advice. If I meet someone and I know what they should do for the next 5 years or what they should focus on, to my mind, don't engage my services. Come back in 5 years' time. I'll tell you what you should do. That's the easiest thing. And then come back in 5 years' time. But most people will eventually get to a point where they are faced with a complex financial decision, and taking a punt or taking a guess at what the right answer is just too risky from a value perspective. So that's when this approach will stop working. The other scenario when the approach might not be suitable is for people that have a relatively low confidence in their ability to kind of understand and grasp and apply the investment fundamentals that I talk about. Of course, some people have kind of a natural flair for it, that it comes a little bit easier to them and that decisions start to become quite kind of intuitive and so forth. On the other hand, in completely other side of the coin is that, a cohort of people that are just never going to get it. It's too complex for them. They don't understand. They don't feel confident. And in that situation, those people are probably, it's worthwhile for them to pay for financial advice, even if you and I might look at their scenario and go, look, it's relatively straightforward. Some people just need that help. And it's no judgment, of course. We're all different, but you just got to be careful about applying this approach. You want to be able to do it confidently so that you're not going to make a costly mistake. And there's a bunch of people that could do that, and there's a bunch of people that can't. Now, often we sit back in our business and talk about stories on how we're helping clients, and it really helps build that sort of holistic approach within our firm. So if we have the accountant share a story of how they helped a particular client, it really then gives great context to help, say, the mortgage brokers and the financial planners to really understand what accountants do on a day-to-day basis and how it could impact and benefit their clients. And it gives everyone a greater appreciation for, the potential value there. And it helps then everyone explore that potential value for their other clients. So, for example, a team member in the accounting team might talk about, a positive story that occurred last week. And in 2 or 3 months' time, one of the financial planners might come across a certain scenario and identify, hey, we know we can help you here. Here's some of the things that we need to think about. So we spend quite a bit of time talking about these really positive stories. It's great for the team. It's sort of great sort of training. I don't want ever, and I said at the beginning, this podcast to turn into a sales pitch. No one wants to listen to a sales pitch. I hate it. I always tune out. So I don't want to do that. But what I'd like to do now is just share a couple of stories to demonstrate kind of how this mentorish kind of approach has worked with some clients over the past few years. I'm going to talk about a client that we've been dealing with for a long time and a relatively new client. It's not a sales pitch, but I just want to give you an idea on kind of how it can work and put some meat around it, because the idea for this episode really came out of some of those conversations around sharing stories. So the first one I want to talk about is they've only been a client for a couple of years. They approached us for mortgage broking services, but we then started to talk about, more about their longer term plans. And we decided that it was best for them to go and invest in a property in Brisbane. They live in New South Wales, actually. So it was interstate purchase. We arranged finance and we introduced them to a buyer's agent we've been dealing with there for, probably more than 20 years. Anyway, the client purchased a house in mid-23 for about 1.1, and the rent was about $850 a week. So about a 4% yield. Pretty good purchase, like in terms of mostly land value, investment grade location with a really good rental yield. Now, the client's plan was always to buy a second investment property as soon as possible, and we agreed with that as well. And so we recently revalued the Brisbane property. The bank valuation came back at 1.4, so earned about 300,000 over the last 2 years in terms of growth. And the client's ready then to buy in Melbourne, and we've introduced them to the buyer's agent we've used in Melbourne, probably for the same time period that we've used the Brisbane buyer's agent, so about 20 odd years or so. And when I look back at this situation, the client got the timing right in terms of the market. And the biggest thing we've really helped them with is our network, is introducing them to the right buyer's agent, making sure that they've got the right brief to those buyer's agents to get the right asset at the end of the day. And now this client's going to buy into the Melbourne market. I would expect, there's no promises here, I would expect similar outcomes for them. And the rental yield won't be as good in terms of 4% gross yield as the Brisbane property, but I expect certainly over the next 5 years the growth to be as good, if not better. And so this client's off to a really great start and able to get into a market that's hopefully just about to enter into a growth cycle, that is Melbourne. And, that mentor relationship hasn't taken us a lot of time, but really just steering the client in the right direction, making sure they're aiming at the right price points, making sure they've got the right team around them can add significant value. Now, another client that I want to talk about is one that we've been working with for much longer, about 16 years, in fact. I can't believe it's that long. Back in 2015, we recommended the client really stretch himself and buy his forever home, him and his wife. And initially, they were going to rent it out, which is what they did to kind of make the debt more affordable because you get the negative gearing, obviously, the rental income. The client already owned a number of investment properties, so we really were kind of pushing the envelope quite a lot in terms of the borrowing capacity and really stretched ourselves. And look, the road over the last 10 years hasn't been perfect. We've had some periods of time where interest rates have been really low, which is fine, and times more recently when interest rates have been higher, which has really stretched the cash flow of this client. But really, if we look back, if we hadn't made that move back in 2015, that move is not affordable today for this client. So back in mid 2015, they purchased for 1.2. Great location, great property, really investment grade. And that house is worth more than $2.5 million today. As I said, unaffordable for that client. But it's really having that foresight and being able to kind of mentor that client through that decision to say, hey, no, we think this is the right way to go. You're young, you've got it might not work out. You might have to sell the asset if it doesn't work out, but it's worth trying. And if we can mitigate our risk as much as possible, so that at least you don't make a loss. If everything was to go bad, your kind of worst case scenario is break even, then we're pretty happy with that potential outcome. And this one decision really that we helped the client make back in 2015, they've got a number of other properties. So there's been lots of decisions along the way, but I just want to focus on this one. This one decision, if we look back 10 years, will have not only substantial financial benefits, obviously from an equity perspective, puts them in a really strong position. But of course, there's great lifestyle benefits because now they're in the location that they really desired with the right schools and all these sorts of things. So they're just a couple of stories, and we do it in our business all the time. Particularly the accountants will look for those sorts of opportunities as well. And I just wanted to share with you, how dealing with the right people, is incredibly valuable. So you should surround yourself with excellent professionals, a great mortgage broker, excellent buyer's agents, a fantastic accountant, a great financial advisor. These people will, if they're the right people, add a lot more value than their fees subtract. But ideally, hopefully, one of those professionals should be able to help you navigate some of those straightforward financial decisions until you get to a point where potentially you might need fully fledged financial advice. Of course, it'd be really remiss of me not to mention that the team members that work in Pro Solutions tax and mortgage broking teams are, of course, eager to mentor clients in the ways that I've described in this podcast. And they've actually got access to a wealth of internal and external resources, including myself and Campbell Wallace, to support them to do that. And they're happy to help wherever possible. So just to recap, you got to understand, are you faced with what should be a straightforward financial decision, or is it a complex financial decision? If it's straightforward, skill yourself up in the fundamentals. If you're listening to this podcast, you're already probably most of the way there, hopefully. And then secondly, go and find yourself a bit of a mentor that can make sure or help you prevent you from making really costly mistakes and broaden your trusted network of other professionals. Okay, let's get into some listener questions. First one is from Dano. Dano writes, I love the show and thank you for the time you put into it. It comes across very professional and engaging podcast, and I've been listening for years. Thank you, Dano. I do put a lot of time and energy into it, so I'm glad you appreciate it. He continues to write, I have a question about foreign exchange. I'm a UK citizen and converted into an Australian resident about 20 years ago. I move money between the UK and Australia, so British pounds and Aussie dollars, a few times a year. Am I required to pay tax on any appreciation in value as a result of the foreign exchange? And Dano goes on to sort of explain that he moves it in sort of $20,000 lots and so forth. And he uses wise.com and asked about foreign exchange via a crypto exchange. Essentially, Dano, of course, this is not tax advice, it's information only. Typically, if you make a foreign exchange gain just from moving monies around and your predominant purpose of that isn't to make a gain, like if you're just shifting money around, then it's unlikely to attract any income tax or capital gains tax. If you are doing it to play the foreign exchange market, so if the ATO starts to think this looks like an investment approach or a business, then it will attract the gain. So it really depends on the purpose that you're using it for. I mean, if you transfer $20,000 over and invest some of that money, then divest it and then bring it back and put it in your offset account, for example, those sorts of activities unlikely to do it. But you say you do sort of 4 times $20,000 transactions per year. Well, depending on what you're doing with the money on the other side, that might start to look like your primary motivation to do that is to make a profit. If the ATO believes that's your primary motivation, then they will include any gains. I mean, you can include any losses too, by the way, if the foreign exchange moves against you. So there's not a really clear answer there. And you probably just want to think about the regularity of doing it and whether it's worthwhile to do it so often if it's going to start to look like, something that you are attacking with a profit motivation. The same answer would be for the crypto exchange as well. The ATO thinks you're there to generate a positive outcome, and that's the main reason for doing it. Then, of course, it's going to attract tax. Again, just information, but hopefully that helps. I should add, actually, Dano actually adds a comment at the end about hedging. I mean, hedging, I've seen a little bit talked about hedging lately, particularly with the Aussie dollar being a little bit volatile. The way I look at hedging is that if I'm investing new money, so money that's not already invested in the share market, and obviously I'm investing overseas, if I have a hedged option of that investment, and typically these days these hedged options don't attract higher fees, and if they do, they're minuscule, so there's not really a cost associated with hedging. And if I think the Aussie dollar is undervalued, that is that I have more downside risk than upside, then I will hedge. So let me explain that. If the Aussie dollar is trading somewhere between 60 and 65 cents, and the long-term average is closer to 70, then my upside is that if the Aussie dollar depreciates further, so if it's 60 cents, look, could it go to 55? That's my upside. My downside is if it's at 60 cents, it could go to 70 cents, and that's going to work against me from a value perspective, and that's my downside. So I always think about my upside and downside with respect to investing new monies. So if I'm investing today and it's 60 cents, I'm going to hedge because I think my downside is much greater than my upside. If I'm investing when the Aussie dollar is 70 cents, I'm probably going to be unhedged. If I'm investing when the Aussie dollar is, say, 80 US cents, I'm definitely going to be unhedged because I think that the Aussie dollar will devaluate from 80 cents. And so there's a few different opinions out there in terms of whether hedging is appropriate, but I think it really comes down to not really a portfolio level. It's really just about, well, if I'm making new capital investment today. Now, if it's a tiny capital investment, who cares? But if you're investing substantial monies, you just want to remove that currency risk, I think, particularly if the Aussie dollar is trading a long way from the 70 cents mark, which is that long-term average. Okay, next question is from Apendra. Apendra writes, I've been listening to your podcast regularly and must say it's significantly expanded my knowledge of both real estate and the share market. Thank you. I wanted to share some details about a question I have. My friends and I, a group of about 10 people, are planning to create a unit trust and invest $500 per person each month into an ETF on the ASX with the goal of benefiting from compounding capital growth over the next few years. After a few years, we intend to use the accumulated funds to purchase a property, possibly paying in full in cash or with a low loan to value ratio. With that in mind, I'd love to hear your thoughts on which ETF or asset classes you recommend for this kind of long-term investment. Additionally, what are the potential benefits and drawbacks of using a unit trust structure for this kind of investment? I greatly appreciate any recommendations or suggestions you might have. Okay, so Apendra, look, firstly, I would say, why don't you just individually invest the $500 per month? You don't need to create a unit trust structure to do that. I mean, some people are going to have, different taxation perspective, and a unit trust structure creates a fixed entitlement. And so therefore, if the trust makes a capital gain, that capital gain, for example, has to be spread equally across the unit holders. That might not necessarily be as appropriate. Whereas one of the investors might have a spouse, for instance, that has a much lower income. They could invest the $500 in that low income spouse's name and minimize some of the tax that might result from a unit trust structure. So I think you're overcomplicating it. I think if it's 10 people, let's get together, save a deposit or save a bunch of money and then go buy a property together. Maybe you could do that individually. I'm not really sure there's a great benefit of doing it through a unit trust structure. And secondly, what about 10 people going and buying a property get together? Actually, I should address the ETF question. It depends on the time horizon. And this is a difficult thing. And I've seen some questions about people saying, first home buyers saying, look, I want to put money into super and take it out in 5 years' time for a housing deposit. How should I invest those monies? If your time horizon is shorter than 5 years, you want to be really conservative. I mean, if you look at previous market corrections, the GFC, it took the market 6 years to get back to where it was before the crash. The dot-com bubble in the early 2000s, it took 7 years. The 87 crash took 2 to 3 years. COVID took less than 12 months. The interest rate shock in 21, when central banks started to aggressively raise interest rates, took about 2 years for the market to get back. So you're really looking at sort of somewhere between, realistically, 1 to 7 years. You need a time horizon of, greater than 6 or 7 years in case that you invest and then, you experience a market crash. So assuming you've got 10 years, I think a diversified ETF would be fine. If your time horizon is less than 10 years, then you just want to be really careful about investing and whether that's really the right approach. Maybe you'd be better off putting it in something that's a little bit more stable, like infrastructure or global property, that's going to generate an income return, a reasonable income return, and maybe a bit of growth as well, rather than necessarily just share markets. In terms of 10 people, owning a property together, one of the greatest benefits of property is control. I've got control over how the property is used, what improvements I might make, all those sorts of things. One of the things that you lose when you co-invest with other people is control over that particular asset. And 10 people, that'd be like herding cats. It'd be really difficult. So I would rather stick pins in my eyes than co-invest with 9 other people into a property. I don't know if that's too subtle. I just don't think it's going to work. I think not everyone's going to have the same time horizon. Circumstances change. Borrowing's going to be challenging because everyone would need to be jointly and severably liable for the debt, which means everyone's on the hook for each other person's share of the debt. Unless the money is raised, the debt's raised outside of the unit trust structure. So if it's an ungeared unit trust, it might be okay, but it's fraught with danger and whatever. Look, I think I've seen situations where siblings co-invest. So you might have 3 people owning a property, but they're related. Even then, that has some challenges, but everyone goes in and says, well, I'm going to buy this property, and every 5 years we're going to decide whether to sell it or hold on to it. So I think if you go into it thinking it's not necessarily going to be a forever situation, it's fine and it can work. But the more people you have, the more complexity there is. And I think, therefore, the greater probability of it not really working out. As I said, one of the benefits of investing in property is control, and you're really foregoing that. But thank you for the question, and I'm considerate of time. I might just leave it there. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.